One of the biggest reasons people lose money in crypto is that they don't know how to build a proper portfolio, not because they picked the wrong coin. More often, it's about investing without a system, without diversification, risk management, or a clear plan, and that all things are covered under portfolio construction. And here's the part that almost nobody talks about. There's a way to build a crypto portfolio that also used by biggest institutional investors managing billions, where you can watch a single coin drop 80% and still not lose everything. It's not a secret strategy. It's not a hack. You can also make a portfolio like a big player because it's a structure. And once you see how it works, you'll wonder why nobody showed it to you earlier. Because if you've ever bought a coin based on a feeling, a Reddit post, a tweet, something a friend told you at 11 p.m., you already know what it's like to watch your balance move and have no idea if you should hold, sell, or buy more. That feeling isn't stupidity. It's what happens when you have exposure without a framework. They are not a system. So, without wasting any second, let's come to the actual point of this video. Here's what this video is actually about. The same principles that protect institutional money, proper allocation, correlation, position sizing work at any level of market. But most beginner content never mentions them. And that gap is where most people get hurt. So let's fix that, step by step. In this video, I'm going to walk you through exactly what you'll learn. Firstly, how to build a crypto portfolio from scratch. Second, the models professionals use. Third, why diversification alone isn't enough. Fourth, the one rule that determines how much you should ever put in. By the end of this, you won't just have a list of coins. You'll have a system designed to manage risk when the market becomes unpredictable. Here's something I want you to think about before we go any further. Two people bought the same coin, same bull run, same year. One of them is still in the market today. The other one never came back. The difference between them had nothing to do with which coin they picked. It had everything to do with what surrounded it, how much of their money was in it, what else they were holding, what their plan was when it dropped. That's the question this entire video answers. And we'll come back to these two people before the end. But first, let me show you the most dangerous trap a beginner can fall into, and why it feels completely correct when you're in it. Picture this. It's late. You've been looking into crypto for a few weeks, maybe longer. You've watched videos, read threads, gone down rabbit holes at midnight, and something quietly starts forming inside you. This could actually change things for me. So you buy one coin, everything you're willing to put in. And then, it works. The number starts climbing. You refresh, still going up. You screenshot it. You tell someone. Maybe you convince a friend to get in. Maybe a family member. And this moment, this feels like you cracked something. Like you finally figured out what everyone else is still missing. But here's what's actually happening underneath that feeling. You haven't built a portfolio. You've placed a bet. And there is an enormous difference between those two things. A bet is binary. It either pays off or it doesn't. You have no protection either way. A portfolio is a design system with layers underneath it, so that when one thing breaks, everything else doesn't break with it. When you have a bet and you think you have a portfolio, you don't discover the problem until the market decides to show you. Nobody warned you about this. It's because most beginner content focuses on which coin to buy, not on how to think about the system that holds it. So let's build that system, right now, from the ground up. I want you to hold one idea in your mind. A smart street vendor sells umbrellas and sunglasses. Rain comes, umbrellas move. Sun comes out, sunglasses sell. Whatever the weather does, this vendor doesn't lose. They didn't predict the weather. They built something that works, regardless of the weather. That is the entire philosophy behind a professional portfolio, not prediction, preparation. And the reason this matters in crypto is one word: correlation. Correlation just means how closely two things move together. Bitcoin and Ethereum tend to move in the same direction. When Bitcoin pumps, Ethereum usually follows. When Bitcoin crashes, Ethereum usually falls too. That means holding only Bitcoin and Ethereum isn't real diversification. Right, you've spread your money, but not at your risk. But when you add something that moves differently, like a stablecoin or another asset, you can also check RWA tokens that are tied to a completely different use case now when one part of your portfolio falls. Something else isn't falling with it, and it can also make a profit at that time. That's the difference between holding multiple coins and holding a system. This is where the core satellite framework comes in. Bitcoin is the anchor, not because it always goes up, not because it's the most exciting asset, because it's the most tested, most liquid, most institutionally backed digital asset in existence. When markets bleed, and they bleed hard in crypto, Bitcoin has consistently been the last thing standing. Surrounding the anchor, the satellites, Ethereum, Solana, Layer, 2 networks, selective altcoins. These are your growth plays. They can deliver returns that Bitcoin can't match in a bull market. They can also go to zero in a bear one. The anchor keeps you alive. The satellites are how you build them. The goal of a portfolio isn't to find the best coin. The goal is to balance stability and growth in a way that matches your actual life, your time, your risk tolerance, what you can afford to lose and still sleep. Hat balance looks different for every person, which brings us to the 3 models professionals actually use. Here is what almost nobody tells beginners. There is no single correct crypto portfolio. There are 3 types. And choosing the wrong one, not wrong for the market, but wrong for you, can hurt just as badly as picking the wrong coins. The first is the conservative portfolio. 80% Bitcoin, 15% Ethereum, 5% stablecoins, digital dollars that don't move with the market, sitting as dry powder when opportunities appear. This model has one job: protect capital first, grow second, minimal drama, and, for a first-time investor, boring is not a weakness. Boring means you're still in the market 12 months from now. The second is the balanced portfolio. 60% Bitcoin, 25% Ethereum, 15% in mid-cap altcoins, Solana, Layer 2 networks, assets with real utility and growing ecosystems. This person is willing to absorb more volatility for more upside. The anchor is still down. Bitcoin still holds the majority, but they're letting a little more wind into the sails. And then, the aggressive portfolio. 50% split between Bitcoin and Ethereum, 30% in mid-cap coins, 20% in small caps projects that could 10x or disappear by next quarter. In a bull market, this model can deliver extraordinary returns. In a bear market, it can draw down more than 70%. Let that land for a second. If you put $10,000 in and it draws down 70%, you're watching $3,000 on your screen. Still there, technically. But psychologically, most people can't hold through that. They sell at the bottom, miss the recovery, and never come back. The question that determines which model you use has nothing to do with which coin you believe in. It's about time. How many years can you leave this money alone? Under a year, crypto volatility is too high. Stay in stablecoins or cash. 2 to 4 years conservative or balanced. You're covering at least one full market cycle. 5 or more, the aggressive model has enough runway to survive even the deepest drawdowns and still recover. Choose the model that matches your real timeline, not your best case hopes, your actual life. Because even the perfect model contains a hidden danger, something that quietly drains portfolios that were built correctly. And this is the part you actually need to hear. You can build a textbook perfect portfolio, diversified, anchored, structured exactly like an institution, and still lose money. Not to the market, to your own behavior inside the system. Every time you trade, every time you sell one coin to buy another, there is a cost, exchange fees, spreads, tax events, many other things. And in countries like India, where crypto adoption is among the fastest growing in the world, that cost is a 30% flat tax on every profitable trade. So, if you're not an Indian, that's okay. But buying and selling every 2 or 3 days, you're constantly touching your portfolio. Every trade usually means another exchange fee. That's why institutional strategies aren't just about allocation. They're about touching the portfolio as little as possible. The friction of constant trading, the fees, the tax events, the emotional buy at 11 p.m. after a tweet can eat a portfolio faster than a bear market ever could. And there is one force that drives most of that friction: FOMO. I also talk about that in my previous video, fear of missing out. A coin is up 40% in a day. Your group chat is on fire. And in your chest, a feeling. If I don't buy it right now, I'm going to miss it. So you buy. At the exact moment the professionals are selling to you, the coin drops. You watch. It falls 20%. You tell yourself to hold. It falls 30%. You panic. You sell. This is not a beginner mistake you make once. For most people, this is a loop that runs for years, invisibly draining what should have been a winning position. The good news is that there is one strategy that breaks this loop entirely. Let me talk about that. The strategy is called dollar cost averaging, and it is specifically designed to protect you from your own instincts. Here's how it works. You choose a fixed amount, $50, $100, whatever your budget allows, and you invest it on a fixed schedule, every week, every 2 weeks, whatever you decide. You do not check the chart. You do not wait for the dip. You do not pause because someone on Twitter is scared. When prices are high, your fixed amount buys less. When prices fall, your same fixed amount automatically buys more. Over time, your average cost drops without you having to time a single entry. Your stress goes down. Your decisions stop being emotional. They become mechanical. And across almost every historical time period in crypto, a consistent approach into a structured portfolio has outperformed the person who tried to time everything. Not because this strategy is magic, because it removes the most destructive element in any portfolio: your greed. And now, the one rule that sits underneath all of this. The rule that determines how much you should ever put in. The most important rule in this entire video has nothing to do with which coins you pick. Here it is. Never put more than 10% of your total savings into crypto. That's the rule. Not rent money. Not your emergency fund. Not borrowed money. And I need to say that last one clearly, because leverage in crypto is one of the most reliably destructive tools available to a retail investor. When you use leverage and the market moves against you, the exchange can close your entire position automatically. In minutes. No warning. No second chance. There are people who went into serious debt in a single afternoon. Not from a bad coin pick, from leverage, on a coin that was actually fine. The people who built real wealth in crypto don't have better information. They don't have secret signals. They have a framework. They decided before they opened any app how much of their actual wealth they were risking. They chose a model that matched their real timeline. They stopped trying to predict the market and started building something that works, regardless of what the market does. And they protected their position from the only thing that was ever truly guaranteed to destroy it: their own worst decisions. It's not glamorous, but it works. Remember those two people from the beginning? Same coin, same market, same year. One of them is still in the game. The other one isn't. The difference between them was never luck, never timing, never inside information. Person A had a system before they bought anything. They knew exactly how much of their savings were at risk. They knew where Bitcoin sat and why. They knew what they would do if it fell and what they would do if it ran. When the market dropped 60%, they didn't freeze. They bought more, on schedule. Person B had something more compelling than a system: a feeling, a conviction. And conviction without structure isn't an investment strategy. It's a bet with a story attached to it. Crypto will crash again. That is not a prediction. That's just history. And when it does, and it will feel catastrophic when it does, the people who built it with a framework won't be the ones running. They'll be the ones quietly buying, while everyone else is selling in panic. Because they built something designed to survive, not to impress anyone. So let's take a quick recap of what we covered in today's video. First, don't put all your money into the same type of asset. Second, choose the right portfolio model for different market conditions. Third, touch your portfolio as little as possible. Fourth, avoid FOMO. Fifth, invest a fixed amount consistently instead of chasing the market. If you have any doubt about any topic, watch this video again, because every principle builds on the one before it. And if you've watched this video all the way to the end, then you've already done something most investors never do. You've learned the fundamentals of crypto portfolio construction. And portfolio construction isn't just another investing topic. It's the foundation that every successful investor builds on. But building the right portfolio is only half the equation. The other half is choosing assets with the potential to outperform over the long term. One sector that many investors believe could become a major part of crypto's future is RWA. If you want to understand what RWA is, why it's gaining attention, and how it could fit into a well-built portfolio, watch this video next.